What's up, traders, and welcome to another installment of the Market Barometrix Technical Analysis series. I'm your host, Neil, and in today's video, we're going to be going over the basic tenets of technical analysis, all in an effort to lay the foundation for the rest of this video series. Now, the three most basic tenets of technical analysis are that price tends to move in trends rather than moving erratically, that the market is a discounting mechanism, and that history often repeats itself. We're going to dive a little more into what each of these means and how you can use it to become a better trader and investor. So without further ado, let's jump in and learn a little bit more about the basic tenets of technical analysis. So again, technical analysis is just the study of movements in price, volume, implied volatility, and other various statistical measures related to the value of a security in an effort to predict future price movements. Now that's just a fancy way of saying we're going to be looking at charts. We're going to use technical analysis to do things like get a quick glance at the overall market, to evaluate the recent and historical performance of individual securities. We'll also use it to compare and contrast the relative performance of various asset classes or, stocks in relation to each other or in relation to the sector or industry that they're in. So generally speaking, we're going to be using technical analysis to evaluate performance in a variety of ways. Now, the beauty of technical analysis, and by the way, I'm going to start referring to it as TA because you guys don't need to hear me say technical analysis a million times over the next couple minutes. The beauty of TA is that it allows us to get a baseline understanding of a huge variety of assets. And historically speaking, analysis of these assets has been reserved for industry or sector specialists, right? It's an amazingly complex thing to try to have a deep understanding of the plethora of financial assets and markets out there. But technical analysis is applicable to anything that can be charted. So even if we don't have a deep understanding of a market or a sector or an industry itself, what we can do is form a baseline understanding of the performance of that asset. TA is universal, and we can apply it to anything from individual securities to the market as a whole. For example, I might not necessarily know the ins and outs of the energy sector, but I do know that when the energy sector is outperforming the rest of the market, it tends to mean that a market peak is near. So using technical analysis to gauge the strength of the energy sector, especially in relation to the other sectors, might clue me into when we're approaching the end of a bull market and nearing a market peak. It's just one example of how you can use technical analysis of, in this case, a sector ETF to gain a better understanding of the macroeconomic environment. In addition, it's going to help us identify the most attractive entry and exit points for our positions. It's important for you guys to know that TA is a school of thought all on its own. There's a whole world within technical analysis. There is a plethora of, technical indicators, overlays, oscillators, momentum indicators, all kinds of different chart patterns. But the purpose of this video series is to give you guys a baseline understanding of the main principles of TA and the main tools that you can use to help you form baseline opinions about any asset that you can get a price chart for. All that said, let's talk about some of the basic tenets of TA. Now, first and foremost, and this is something you guys have probably heard before, the trend is your friend. Now, technical analysis operates under the assumption that price will exhibit trends and are more likely to move in relation to past price movement than to move erratically. So this plays to the concept of trend lines, support, resistance, channels, consolidations, chart patterns, price gaps, right? So at the core of TA is the fact that price doesn't necessarily move erratically, but can be forecasted with greater probability by looking at the past, identifying common patterns, and putting those in the context of what's going on right now to forecast what's likely to happen next. Basic tenet number 2, the market is a discounting mechanism. Now, this just means that technical analysts generally assume that the price of a stock is an accurate reflection of all available information about the value of a company, industry, sector, market. This includes everything from companies' fundamentals to the overall market environment and individual investor perception. This is known as the efficient market hypothesis, which states that share prices reflect all available information. What this is saying, in essence, is that the price that you see on a chart is a reflection of all the information that's available. Consider the fact that there are millions of market participants. And let's say that even a small percentage of those market participants are doing their due diligence and performing deep research on each of these assets that they're potentially investing in. The efficient market hypothesis and the concept of the market being a discounting mechanism makes reference to the fact that price should be an accurate reflection of the market's aggregate opinion about the value of an asset, because the market as a whole is able to consume all the available information about that asset. Basic tenet number 3, history often repeats itself. Now this is similar to the trend is your friend, but this goes a step further. Now, price movement is often predictable, but that's not to say that just because a stock is in an uptrend that it's going to remain in an uptrend. This alludes to the fact that TA is something of a self-fulfilling prophecy. The fact is, there are millions of market participants all around the world looking at more or less the same basket of securities. And many of those market participants are employing the principles of technical analysis. If you have 1,000 people seeing the same chart pattern develop and they're trading that chart pattern in the same way, their collective actions based on the technical analysis that they're performing are actually going to push price to do what they think it should do. For example, if you have a chart pattern developing that, tends to lead to the stock moving up, once the pattern resolves, you can expect that the market is going to make note of that pattern developing and that there's going to be a ton of investors stepping in to buy at whatever point they think that chart pattern is going to resolve. So all of these investors think that price is going to go up at a certain point, and all of those investors stepping in at the same time and buying is going to push price up. So if for no other reason, price ends up going up because the market thinks that price might go up. Based on the market thinking that the price is going to go up, they step in and buy and push the price up. A self-fulfilling prophecy. There you go, folks, the foundational principles of technical analysis. Understanding what it is and why it is, it's going to help us to better understand how we can use it to make smarter investment decisions and, what its limitations are. So if you guys like this video, don't forget to subscribe to the channel, hit that like button, comments down below, and until next time, thanks for tuning in. We'll see you guys in the next video.